All right, let's get right into it. It is Friday, December 19th, 2025. The implied open is, well, it's frankly a mess of mixed signals.
It really is.
We've got S&P 500 futures just nudging up, maybe 0.2%. Nasdaq's leading, stronger by about 0.4%, but then the Dow is essentially flat.
Right.
So if you're looking for some big directional signal this morning, you're not going to find it in the futures. This is just investor indecision.
It's the definition of a tug of war. And the main rope pulling on the bull side, well, that's undoubtedly the overnight catalyst.
The CPI print.
Exactly. That cooler than expected CPI print. November's inflation number landed at 2.7%. For you, the active trader, that number, anything sub 3%, is gold.
Oh, absolutely.
It just instantly cranks up the volume on that whole lower rates in 2026 narrative.
And that's the engine, right? That's what's driving the strength we see, specifically in the duration-sensitive Nasdaq. But, and this is a big but, we can't ignore the global complexity being poured into this.
You're talking about the Bank of Japan?
We have to spend a moment on the BOJ. They hiked their rate to 0.75%. So even with our domestic inflation cooling, that move is pushing global bond yields higher.
Exactly right. It adds a ton of complexity because it means fixed income isn't, uniformly signaling lower rates. The U.S. bond market is pricing in Fed cuts, sure, but then you have a major global central bank tightening that creates cross currents that influence our rates too.
So you have this conflict, domestic optimism from that soft inflation print, but it's pitted right against real corporate execution risks and this global yield tightening.
Yeah.
So here's our mission for this deep dive. The market is completely bifurcated. Some sectors are screaming higher on rate hopes, others are just crashing on their own news.
Sort of split.
Is today going to bring any clarity, or are we just set for another whipsaw session right into the year-end close? Let's unpack it. First, let's look at the sneaky headwinds trying to sabotage that CPI lift.
We have to maintain vigilance here. Even with the Nasdaq's pre-market bounce, there are two macro factors applying direct pressure to that high-growth tech sector. Let's start with the 10-year.
The 10-year Treasury yield.
It's ticking up slightly this morning. We're sitting at 4.15%, just a tiny move, 0.02 percentage points.
Okay, 4.15% isn't, threatening on its own. But any move higher feels counterintuitive to the rate cut story.
Yeah.
Why does that tiny 2 basis point bump matter to a tech trader today?
Because it shifts the goalposts for valuation. Rising yield increases the discount rate. That means the promise of huge earnings 5-10 years from now, which is the core bull thesis for growth stocks.
Right.
It's simply worth less today. Plus, it increases borrowing costs for companies that need that debt to fuel expansion. It's subtle, but it's a real headwind.
It's the constant drip. And then you couple that with the strengthening dollar. The DXY is flexing. It's up 0.22% to 98.64. I have to say, I would have expected the dollar to soften if the inflation narrative was truly that aggressive.
And that's the critical conflict you just hit on. The dollar strength is a double whammy for these big multinational tech companies.
Well, what?
It makes their products more expensive for international buyers. That could hit demand. And crucially, it shrinks the value of all their overseas earnings when they convert that revenue back into U.S. dollars.
So when you put them together, the upward move in the 10-year and the DXY, you get this clear, coordinated pressure point right on the technology sector. Even if the NQ is gapping up on some AI news, it just makes any rally feel very, very tentative.
Tentative is the perfect word, and this brings us right to the pain trade. If that 10-year yield decides to, accelerate quickly past 4.20% today, the risk flips dramatically.
Okay, let's define that pain trade for everyone listening. What does that actually look like on a chart?
It's a sharp institutional rotation. Smart money does not wait for confirmation.
They just move.
They just move. They instantly cycle out of those long-duration growth stocks, your high multiple tech names, and pour capital into less rate-sensitive areas. Value, cyclicals. The danger for the retail trader is getting caught flat-footed. Missing that initial shift and being left holding stocks that are just collapsing because the institutional bid is gone.
Evaporated.
You have to monitor that yield curve as if it were a tech stock ticker today.
That is a great reminder. The overall landscape is often dictated by things way outside the tickers we're watching. Now, let's pivot. Let's move from those headwinds and look at where the capital is actually flowing, because something is obviously overcoming that DXY and yield pressure. And, well, unsurprisingly, the strongest sector flow is anchored squarely in tech.
Specifically AI and semis.
AI and semiconductors.
The conviction here is it's almost unbreakable right now. It's structurally driven. Capital allocation is just sustained by this relentless demand for AI-driven semiconductors, the data center build-out. You hear nonstop talk about an AI bubble, but corporate balance sheets are confirming real immediate spending.
And that's why we have to look at the pre-market gappers. They tell the whole story, what the market is rewarding and what it's punishing. On the bull side, Micron, ticker MU, it is absolutely ripping.
Ripping is the word.
Up over 10% on pre-market volume. That is a textbook gap-and-go setup.
It's a monster move. And it's driven by a blowout Q1 earnings report and, frankly, incredible dividends. But the real driving force is specific. It's memory. The tightening supply in high-bandwidth memory, HBM.
Which is mission-critical for AI servers.
Exactly. Micron is a pure play on the infrastructure build-out itself. That 10% surge is a high-conviction signal that supply constraints and demand are converging right in Micron's favor.
Now, you contrast that conviction with the bearish story of the morning.
Nike,
NKE.
Yeah.
Plunging more than 10% pre-market.
Yeah.
The dichotomy between MU and NKE, it tells the entire story of today's market. Hyper-specific infrastructure growth is king.
And global consumer execution is being brutally punished.
Brutally.
Precisely. Nike's hit came from a very weak sales outlook. They cited poor performance specifically in Greater China, but then it's compounded by tariff pressures hitting their margins.
Hard.
This isn't a broad consumer is slowing down story. It's a specific regional tariff-related margin contraction problem. You can't hide execution risks when the market is demanding perfection.
No, you can't. The fact that a tech stock is up 10% and a consumer staple is down 10% shows you the massive sector rotation at play. That bifurcation, the euphoria in some tech versus the deep fear in cyclicals, makes our next section crucial. Let's zoom in on 3 high-volume, high-interest tickers where smart money might be placing its structural bets, starting with the AI bellwether, Nvidia, trading near $174.14 pre-market.
The conviction on Nvidia is still immense. We just saw Tigris Financial lift its price target all the way to $350.
$350. That's nearly double where it's trading.
It's a huge number. It shows incredible confidence that this AI cycle has years, not months, left to run.
But the valuation is always the debate. If we look at the bearish side, the stock is trading, about 26.7% above its DCF intrinsic estimate. For traders who might not be familiar, what does that DCF figure essentially tell us?
It's a sanity check. DCF estimates what a company is truly worth based on the cash flow it's expected to generate in the future. Trading 26.7% above that means the market is pricing in exponential growth and near-perfect execution, with zero hiccups.
So the bear case is that it's just overvalued. Any bad news, and it triggers a major derating.
That's the whole thesis.
So with that tension, what specific levels confirm the bull case today? Where do we see sustained momentum?
We need to see volume follow through. The immediate bull case is a clear, sustained break above that $260 to $300 range. That challenges the consensus analyst target of $261.11. If it breaks convincingly, that $350 target from Tigris is in play.
And for the bears?
For the bears, you watch the immediate near-term support. That's $170.94. If the stock slips below that, it could trigger the critical stop-loss level noted at $165.74. A break there, and that whole valuation argument takes center stage.
All right, moving on. The pharma blockbuster play, Eli Lilly. LLY. This story is pure pipeline momentum.
It is. It's driven by the obesity drug market and that battle with Novo Nordisk.
What's the latest catalyst?
They dropped hugely positive phase 3 data for their oral GLP-1 candidate, or for Glipron.
An oral option.
An oral option gives them a massive competitive edge over rivals who still rely on injectables. And the market is rewarding that growth. Q3 revenue up 53.87% year over year. Analysts are projecting 37% annualized earnings growth.
Those are explosive numbers. But the market has already priced in a lot of that success. The stock's trading over 50 times trailing earnings. That is highly stretched. What level invalidates this bullish story?
Well, the bull case assumes flawless execution continues. The momentum from these clinical trials is targeting the $1,200 to $1,300 range. That's well above the median analyst target.
So it's trading on pure hope.
Pure hope and pipeline. The bear case is entirely centered on valuation fragility. Any unexpected clinical setback, any regulatory scrutiny on pricing, which is huge political risk,
Always.
or competitive pressure that diminishes that oral candidate's edge, that could trigger a massive correction. The critical downside level for LOY is a drop below $950.
Okay, finally, let's analyze the high-stakes turnaround. Intel, INTC. Trading around $36.22, near the low end of short-term forecasts. That tells me the market is deeply skeptical.
And that skepticism is understandable. But the bulls do have some fresh ammunition. There were whispers of a major Apple manufacturing deal. They're pushing hard on their AI PC offerings. And critically, they secured $7.7 billion in funding.
And analysts are projecting, what, 76% earnings growth in 2026?
They are, but that comes with a massive asterisk if the turnaround succeeds.
It's a huge if. I mean, their Q3 2025 foundry losses were over $3 billion. That is a lot of red ink to overcome. What specifically needs to happen for the market to believe the bull case here?
It's purely about execution and manufacturing. The bull case is confirmed by them successfully building out the foundry business and scaling the 18A node. That's their bleeding edge process. For you, the trader, look for a break and a hold above that $38 to $40 plus range. That's the line that says, yes, we believe the execution risk is receding.
And the risk level that confirms the bearish fragility.
The bear case is defined by them continuing to lag in AI market share and those operational losses in the foundry. Trading below $35 signals vulnerability. If Intel can't hold that $35 floor, the market is basically saying it doesn't believe the turnaround story yet, and more downside is likely.
The divergence we've just covered, Micron surging, Nike collapsing, these highly stretched valuations on LLY and Nvidia.
Yeah.
It means technical levels are absolutely paramount today. We are operating in a neutral, highly selective market.
Absolutely. When sentiment is neutral and catalysts are conflicting, price action at key technical lines, that determines direction. You have to differentiate between a high-conviction breakout, a sustained move with accelerating volume, and a deceptive liquidity trap.
I want to focus on that trap. A liquidity trap is designed to do one thing, right? Shake out weak hands or trip up stop losses.
That's it exactly. It's a quick reversal after a false move. It's institutions fishing for those stop losses before they move the price the opposite direction. You have to wait for confirmation.
So let's apply this. The S&P 500, the ES. How do we treat resistance on the ES today? What is the resistance line in the sand?
That line is the recent high or a key supply zone. Your action plan has to focus entirely on confirmation. If you see a spike above that line that's immediately rejected and the price pulls back below, that's a trap. Bears are trapping longs.
And you only follow...
You only follow momentum if it sustains the move and the volume accelerates.
Got it. And what about the support line in the sand for the ES?
That's your critical demand zone. Here, you have to determine if a sharp dip reverses quickly. If bulls absorb that pressure and the price snaps back, that's a classic trap to clean out weak sellers. If, however, it breaks decisively, especially on accelerating volume, that signals undeniable bear dominance, a confirmed bearish breakout.
Okay, now let's move to the Nasdaq, the NQ. It has that pre-market momentum from the AI names. How should traders approach its resistance today, especially given that sector's tendency to fake out?
For the NQ, you've got to focus on that overhead barrier. A swing high, a Fib extension, whatever it is. You must look for a clear push and a hold above that resistance for at least 2 time intervals. That's how you confirm bullish momentum.
And if it fails?
A failed attempt followed by a swift, sharp reversal down that signals a clear fake out. And it means renewed selling pressure is coming back into tech, probably triggered by those macro headwinds we talked about earlier.
And if that pivotal floor, the support for NQ, gets tested?
We want to see how the market reacts to a test. If a strong recovery follows a brief breach, that's your liquidity grab. Shorts get squeezed, the bounce is confirmed. But a definitive break below that floor suggests a clear, alarming bearish shift for the entire tech complex.
And that would be the market signaling that the DXY and 10-year pressure has finally overwhelmed the CPI optimism.
Yes.
So the overall posture for the morning is this. Vigilance is key. Do not chase the initial move. Recognize that the market is actively setting traps today. We have to wait for the price action around those critical lines to confirm if we're seeing a sustained trend or just a shakeout.
Absolutely. Never trade the immediate reaction. Trade the response to the reaction. Today is all about patience until those liquidity traps reveal themselves at those defined lines.
Okay, let's wrap this up with the big picture. We've established this inherent tension. The CPI cooling provides a temporary sort of feel-good macro lift. But that is directly countered by severe corporate headwinds, like Nike, and these persistent macro threats from the dollar and yields.
Right. So the provocative thought for you today, the active trader, is to focus on institutional rotation velocity. If that CPI lift proves temporary and those corporate execution risks persist, where is the smart money truly allocating capital? Is the AI and semi-sector the only safe rotation out there?
Or is the volatility we're seeing signaling something deeper, a sector-agnostic retrenchment, a fear that says, look, we like the lower rates story, but we hate the actual P&L outlook for most companies?
And if it's the latter, then even the gappers like Micron, fueled by these high-conviction catalysts, could quickly become susceptible to broader market weakness if the indices fail decisively at resistance. Stay nimble, question the narrative, and always, always question the why behind every move that hits those critical line in the sand levels. Trade smart today.